Good morning and welcome to Financial Accounting. As always, we start with that look at our calendar. So we finished Chapter 12 on Monday. So the Chapter 12 problem should be submitted for grading by the end of the day if you're done with it. And we do have the drop-in review session scheduled for tomorrow morning at 10:45 to 11:45. If you wanted to talk about that Chapter 12 problem at that review session, obviously don't turn it in today. And that's fine. If you do plan to attend that review session tomorrow, just keep in mind I have class until 10:40. So I will get into that other Zoom room as quickly as I can. And I should be able to be there by 10:45, but I might need an extra minute or two. Excuse me, we'll be starting Chapter 13 today on the statement of cash flows. And so you should complete and submit the Chapter 13 pre-quiz by the end of the day today as well. If you do want to attend that review session tomorrow, please make sure you sign up in Starfish. It is important that we keep track of the number of students that are attending those. As I think I told you, when we started doing those several weeks ago, it's kind of a pilot. So that option in Starfish didn't exist prior to halfway through the semester. And we're trying to see if people are using it and how they're using it and whether we should be encouraging other faculty to use that. So please do sign up in Starfish if you are going to be attending so that we have a record, not that you attended, but how many people are attending. As we look ahead then to the very end of the semester here, I know you've heard this before, but I just like to keep it fresh in your mind. We'll be covering Chapter 13 today and Monday, Chapter 14, then Wednesday of next week, and the following Monday will be our last day of new material. So the 11th is officially a class day, but that would be our drop-in review session for that week. If you do have any lingering questions that you need to go over with me. Otherwise, if you're good, if you don't have any questions, you don't need to attend class on that final day. There will be no new material covered. We will have finished on the 9th. And then Friday the 13th is the final day of the semester. That is the deadline for submitting any outstanding work. So if you have assignments that you've been working on in CNOW, but you haven't hit the submit for grading button, please make sure you do that no later than the 13th, but the sooner the better. This Monday, like 2 days ago, after class, I went through the gradebook in CNOW and made sure everything was up to date in Blackboard at that time. So what you see in Blackboard right now reflects all of the work that you have submitted for grading in Blackboard. I've also been making some progress on the annual report projects. So some of you may have seen grades come in for those in the last couple days. I'm continuing to work on those over the next couple days, today and tomorrow. So hopefully I will be caught up soon on those as you continue to submit more. If you have any outstanding work, then as I said, May 13th is the last day that I will accept any work because grades are then due on Monday the 16th. So I will need to have time to finish all of those grades and get everything up to date in Blackboard. Keep in mind that the Blackboard gradebook at this point does not show zeros for anything you have not yet submitted because you still have the opportunity to submit late work. So I don't put in zeros until that May 13th deadline passes. So at that point, if there's anything you haven't done, including projects, exams, exercises, quizzes, homeworks, anything that has not been submitted for grading on the 14th then becomes a zero. So keep that in mind. If you look at your grade right now and you're really happy with it because it says A or B plus or whatever, that if you have outstanding assignments that you don't complete, that's going to pull your grade down because they're not calculated, they're not added into your grade at all. Right now, the only grades that are included are the ones that you have actually submitted. Good morning, Chance. Glad you found us. Good morning, Chance. Glad you found us. Don't know if you heard me the first time. It looked like you were still connecting. We're just finishing going over the calendar here, and then we are now at the point where if anyone has any questions on chapter 12 that we finished on Monday, the stockholders equity chapter. So we talked about throughout that chapter the entire life cycle of stock, why a company sells stock, what permissions they need to get to do that, how we record it when they sell stock for cash or other assets. We talked about dividend policy, the important dates related to the declaration and payment of dividends. We talked about preferred versus common stock. We looked at treasury stock and then the statement of stockholders' equity. So any questions from chapter 12? Okay. I did not point this out to you on Monday, and I realized I should have. If you go into the chapter 12 reference materials folder in Blackboard, you'll notice that there is a link here at the top to a page called Helpful Hints for the Chapter 12 Problem. So if you are working on that problem, which ideally would be submitted today, if you get stuck, this would be your first place to go look. You may even want to read through this before you are working on the problem if you haven't been working on that yet, because it gives you some pointers about the types of calculations or the types of information you might need to complete that problem. So I should have pointed this out to you. Hopefully you noticed it in the reference materials folder for the chapter, but it's here. And I apologize that everything is squished together like that. For some reason, if I were to show you the unedited version, see, I have spaces in there. I don't know why that on this particular page, Blackboard decided it just didn't need to put any of those spaces in there. I don't know why it's doing that. So I apologize that it's kind of all squished together. Hopefully you can read it. So anything you want to talk about before we get started with our new chapter? All right. So you will want to have open the chapter 13 exercises in See Now. We will get to those shortly. We need to do, of course, some introduction to the chapter first before we start working our way through the exercises. So, statement of cash flows. As you know, this is the fourth and final of the 4 required financial statements. All companies prepare these 4 financial statements and include them in the annual report that you've been analyzing for your project throughout this semester. We have several learning objectives. There's a couple more on the next slide as well. And so we'll start out talking about what shows up on the cash flow statement. The cash flow statement is divided into 3 main areas, and you can see those in learning objectives 2, 3, and 4 here: operating, investing, and financing activities. So we'll look at exercises related to each of those. The operating activity section is the most involved. It's the most challenging to put together as well. So quite a bit of our time on this chapter will be spent on learning objective 2. Ultimately then, by the end of the chapter, we will know how to create the entire cash flow statement by putting all of those parts together, the operating, investing, and financing section. Excuse me. You'll notice that on this slide, there are 2 learning objectives related to the appendices to the chapter. As always, we will not be covering those appendices. You're not responsible for reading or answering questions. We won't be including them in the exercises or problem or on the exam. It is possible, I don't know for sure, it is possible that you might see a question related to one of the appendices on the pre-quiz, because I can't control what's on that. So if you do, you can either guess at that question, or you can look at the appendices. Certainly, I'm not telling you not to look at them. I'm just telling you you're not responsible for what you see there. So luckily, if it does appear on the pre-quiz, you only need to get a 60% to get full credit for that. So I guess I can tell you realistically, if you see a question that you think is from one of the appendices, you can ignore it. So in chapter 1, which now seems like a long time ago, although it's snowing again today, so maybe it wasn't that long ago that we were in January. But in chapter 1, we talked about the 4 required financial statements. Income statement, statement of stockholders' equity, which we now covered in chapter 12. The balance sheet, which we spent many chapters, like chapters 6 through 11, we're focused on different areas of the balance sheet. And now we get to the final of those 4 statements. And I think it will be very clear to you as we go through this chapter why we save this one till the end. Because there's information from each one of the other financial statements that we need to understand, know how to find it, know what it means before we can prepare the statement of cash flows. So that's why we haven't really talked about it. We mentioned it and then we kind of put it aside. Then I said, we'll come back to it at the end of the semester. So here we are looking at the statement of cash flows. In chapter 3, we talked about accrual accounting and what that means. We contrasted that with cash basis accounting. Well, if we did cash basis accounting, there would be very little need for a cash flow statement, because what was on our financial statements would already reflect the changes in our cash position. So the reason that we need the cash flow statement, though, to evaluate the liquidity or the access to cash, the cash generating efficiency of our organization, is because we use accrual accounting. Because sometimes we put things on the income statement before we receive the cash or pay out the cash. Sometimes we receive cash and it doesn't go on the income statement right away because we defer that revenue or we defer that expense. So the purpose of the cash flow statement is primarily to take what's on the income statement and translate it into, yes, but how did this affect our cash? Every business has 2 main goals, and they are liquidity and profitability. So liquidity is how much cash do we have? Do we have enough cash to meet the needs to keep our company running? To pay our suppliers so they keep selling us stuff, to pay our employees so they keep coming to work, to pay our taxes so that the government doesn't, shut us down. That's really the information we can get from the cash flow statement. The other main goal that I mentioned is profitability, which is making money, earning a return on the operations of the organization. So that profitability question can be answered on the income statement, but the liquidity, the cash question, really can't be answered on the income statement because of the concept of accrual accounting, primarily. So what we are going to be looking at on our cash flow statement is how our cash changed from the beginning to the end of the year. The whole body of the cash flow statement, the purpose, what it shows us is what changed with our cash this year. And then at the end of the cash flow statement, there is a reconciliation piece where we show, here's what the balance sheet had for cash at the beginning of the year. Here's what it had at the end of the year. Yes, we have answered all of the question of why did our cash change like that? If you like the balance sheet because it balances, because when you're done, you see, here's our total assets, here's our total liabilities plus equity, they're the same. So I'm pretty confident that I've done this right. If you like the balance sheet for that reason, you will also like the statement of cash flows, because when we get done, there's that check. Did we explain completely what happened to our cash during this period? I don't know that we talked about this in class, but in your textbook in chapter 1, it talks about the 3 different types of activities that companies engage in. And the 3 different types of activities are what I've already mentioned when we were looking at the learning objectives: operating, investing, and financing activities. And so we divide the cash flow statement into 3 sections. The longest section is the one that you can see on the screen right now, cash flows from operating activities. This is the day-to-day stuff that we do in running our business: selling product to our customers, buying product from our suppliers, paying our bills. This is the stuff that we do all the time. And so that's one explanation for why the operating section is the longest section. It takes up probably half of the space generally on our cash flow statement, because it's the stuff we're doing all the time. The other 2 sections are activities that happen much less frequently for most companies. The second section is the cash flows from investing activities. So that includes buying and selling of plant assets, property, plant, and equipment kind of things that we use. So if you are a manufacturing company, you're not buying new equipment every day. You might not even buy much equipment on an annual basis. And so you're going to see a lot less information in this section, a lot fewer lines. It also includes buying and selling of financial investments. So if we're buying stock or bonds in other companies or government bonds, those long-term investments, financial investments, are also going to show up in the investing section. So again, investing activities can be financial investments or real property investments. Buying and selling, both of those. And then the third section is the financing activities, which is where do we get the money to do what we're doing? So things that affect debt and equity, it's going to include borrowing money, which could be done through selling bonds, issuing notes. It's going to include repaying the money that we borrowed, not the interest part. Paying the interest is considered an operating activity, but paying back the principal that we borrowed is considered a financing activity. It could also include selling our own stock or repurchasing some of our own stock as treasury stock, as we discussed in chapter 12. And it would include any dividend payments that affect our cash. So those are the 3 principal areas of the cash flow statement. Everything that happens in our company, we're going to be looking at, is this an operating, investing, or financing activity, and how did it affect our cash, if at all? And so you can see kind of a summary of what is on the cash flow statement. We start with our operating activities, and we'll have a dollar amount in total that's generated from our operating activities. Now, that dollar amount, the cash flows from operating activities, could be negative or positive, and we'll see that. If you find a negative value there, doesn't mean it's wrong. It's not really a good thing for the company, but it does happen sometimes. Cash flows from investing activities will have a dollar amount there. Again, it could be a negative amount. Actually, a negative amount in investing activities is not a bad thing at all. What that tells you is the company is spending money to grow the company. that they're buying new machinery, equipment, whatever they need to run the company. Cash flows from financing activities will be next. We list and total those. Again, that number could be negative. A negative number in the financing activities means, in essence, we're paying off debt. And so again, not a bad thing. We then add those three numbers, those three totals together to find out our total change in cash. If any one or all three of those numbers could be negative, then obviously the change in cash could also be negative. Our cash balance may go down during the year, and that's not necessarily a bad thing either. It's not automatically a bad thing. And then finally, we end with what was our cash on the balance sheet at the beginning and end of the period. And as I said, this is the reconciliation to make sure, yes, we have totally explained how our cash changed during the year, during the period. So the heading on a cash flow statement is going to look very much like the heading on our income statement, the statement of stockholders' equity, but not like the balance sheet. So the first line, of course, is always going to be the name of the company. The second line is going to be the financial statement that we're preparing, in this case, the statement of cash flows. The third line says the date or range of dates that the statement covers. And so that's why I say this is like the income in the statement of stockholders' equity, because it gives us that moving picture. What happened during some period of time? So we need to specify, are we talking about the week, the month, the quarter, the day, the year, what? Okay, so that third line of the heading is going to show the range of dates, just like the income statement would. So when we think about cash flows, cash could be coming into the business. We call that a cash inflow or a source of cash. And cash also could be going out of the business, a use of cash or a cash outflow. On this financial statement, it is very important that you use negatives and positives consistently. So in many of our other exercises, I have suggested you can use a negative if it helps you to remember to subtract. The software has allowed us to use negatives or not use negatives on many of the exercises we've done throughout the semester. And by the way, in case you're wondering, you have now done 120 exercises plus 12 problems. So we have 20 more to go. We're getting there. So for this chapter, it will be very important that you use negatives to indicate a use of cash or a cash outflow, something that indicates our cash balance would go down, and that we use positives only when we're talking about a number that increases our cash, a cash inflow or a source of cash. So I've given you some examples there. This diagram is also in your book if you find this helpful as a reference to kind of remind you of what I've just said about the three different types of activities: operating, investing, and financing, and the types of transactions that would appear in each one of those areas. This nicely has them divided by what causes cash to increase and what causes cash to decrease. These are certainly not the only transactions or activities that might happen, but these are good representative examples. Couldn't come up with a better word. So investing and financing, what you see in these boxes really does summarize everything that would happen there. It's the operating section that all those other transactions, all those other activities fall into the operating section. So we really just have a couple different examples there. It's not an exhaustive list. Okay. If you read in the learning objectives, the two learning objectives that I set for the appendices that I said you don't need to do those, you may have noticed if you read them that the second appendix said it was for the direct method. As you can see on this slide, there are two different ways of calculating operating cash flows, the direct and the indirect method. The only method we are using in this class, the only method you are responsible for, is the indirect method. I'm sorry to tell you that the direct method is actually easier. However, very, very few companies use it. Something like less than 5% of large companies use the direct method. And as you may notice as we go through this chapter, the reason that companies don't use it, even though I just told you it's easier, is because our accounting information system, the computer, the way the computer is set up, the way we enter transactions is not set up to allow us to access the direct information. So even though it's easier to understand when we look at it, most companies don't use the direct method because it's more difficult to get at that information in our accounting records. The dollar amounts would be the same regardless of which method we use. And so since most companies use the indirect method, since that's what you'll be seeing almost certainly on your annual report project, company that you chose when you do your Chapter 13 piece, for that reason, we are doing the indirect method only. If you look at your company's annual report and look at their cash flow statement in the operating section and think, this doesn't look like what we did. If you have a question about that, obviously you should ask. I think it would be neat if one of you had, just by pure chance, chosen a company that uses the direct method, because there are so few of them that do. But if you think you spot that on your company's cash flow statement, please bring it to my attention, and I would be happy to share that with the class, just because it's kind of cool. This is what the direct method looks like. What did we spend money on? What did we receive money for? Who paid us? Who did we pay? Very simple to understand, but not so easy to access that information from our accounting records. I should point out that the direct method versus indirect method, that question, that choice between the two only affects the operating section. So regardless of which method, direct or indirect, your company uses for the operating cash flows, their investing and financing section look the same, regardless of which method they use for their operating cash flows. This is what we are going to be doing, the indirect method, and the general format is we start with net income. How do we know the company's net income? We look at their income statement, right? So remember I said in order to use to create the cash flow statement, we need to understand those other financial statements as well. First, here's our the very first number that you see on the cash flow statement comes directly from the income statement. So we start with their net income. Keep in mind that net income could be negative. It could be a net loss, right? So we start with that number from the income statement. If it's a loss, you need to make sure you use the negative. Show it as a negative. And then we're going to have a series of items to reconcile that income to cash flows. There are two different sources for those adjustments. And I'm going to stop here for a moment and go to Blackboard. So what I'm going to pull up now is, again, in the reference materials folder, and it's in Chapter 13. So you'll notice that the very first piece of information in the statement of cash flows, and it's not even a separate page you have to click on, it's all right there, gives you some guidance for calculating operating cash flows. I will refer to this page constantly as we work through the operating cash flow section of the cash flow statement. As I said, we're only going to be using the indirect method. So we start with net income or net loss from the income statement. Then we have two different sets of adjustments or reconciling items. What I have labeled here as number 3 are the adjustments that come from the income statement. And then what I have labeled here as number 4 are the adjustments that come from the balance sheet. And so as we work through these exercises, as we put together our own cash flow statement, I will continually refer back to this. This is such an important page to me. I think referring to this rather than the way it might be presented in the book, I think this is much more straightforward, and it's just one page. You may want to print this page or somehow screen capture it so that you can easily refer back to it at any time, as I will do. But that's enough of me talking. I want to go now to our first exercise and at least get started on our exercises before I start talking again. I think we've gotten a lot of information here in the last, half hour. So we start with our first exercise, which is the effect of transactions on cash flows. So going through these 8 different transactions that happened here and thinking about what really happened and how, if at all, this would affect our cash is going to give us a good start for what we're going to be doing, putting together the cash flow statement. So we've already talked about the 3 different types of activities, the 3 divisions on the cash flow statement: operating, investing, and financing. This exercise does not ask us to think about what type of activity, but since we've already talked about that, I'm going to ask you that additional question for each one of these. So let's start with letter A. We're asked to determine whether it's a cash receipt or cash payment. So that's going to be the choice here. Cash receipt would be a cash inflow, would show as a positive. Cash payment, of course, would be a cash outflow, a use of cash, and that would be shown as a negative on our cash flow statement. Letter A says, we retired $500,000 of bonds. So thinking back to chapter 11, when we talked that entire chapter about bonds, $500,000 would be the face value of those bonds or the principal. There was a $4,000 unamortized discount. So the carrying value of those bonds at the time that we retired them was $496,000. The face value of $500,000 minus that unamortized discount, the discount remaining. But we retired them for $510,000. So remember was it in chapter 11? Yeah, so remember in chapter 11, when we talked about recording gains and losses, when we retire bonds, retire them early. If we had kept these bonds outstanding until the end of their maturity, we would have had to pay $500,000. We, the company, decided to retire them early and paid more than that, $510,000. Remember, I said the carrying value was $496,000. Why would we pay $510,000? Because that's the prevailing price on the market right now. We just want to get those bonds off the market because now we don't have to pay interest on those bonds anymore. That might be one reason. Maybe we're going to reissue some other bonds at a lower interest rate. And if you look down here at letter F, it does tell us that we sold a new issue of bonds. Our question for this exercise, though, is this a cash payment or a cash receipt? So did we pay out that money or did someone pay us? Obviously, we paid out the money, right? We retired our bonds, we paid them off early, and the cash flow is the $510,000. That's how much we had to pay. I told you I was going to ask the additional question of what type of activity is this? So paying off our own bonds that are outstanding is related to financing. This is a financing activity, and that cash outflow would show up in the financing activities section of the cash flow statement. It would show retired bonds minus $510,000 because our cash went down by that amount. It was a cash payment. But if you remember what we talked about in chapter 11, and the way I just explained this, we actually took a loss when we retired those bonds, right? The loss was $14,000. We paid $510,000, but our books only showed them as being worth $496,000. So the difference, the other $14,000, represents a loss. On our income statement, then, we would have shown that loss. Because it's on the income statement, it would be included in the net income that we said is where we start the operating section. And so I just want to point out right now that when we get there, and we'll get there in the next couple exercises, when we get there, maybe exercise 3, when we get there, we'll have to deal with that loss in the operating section. The question for this exercise is just, where does the cash payment show up? How much is the cash payment? And I said that part would show up in the financing section. We still got to deal with that loss. Let's go to letter B then. We sold $20,000 of $5 par value common stock, and we sold it for $30 per share. We sold some of our own stock. Did we receive money for that, or did we pay money? We received it. How much did we receive? Well, it was 20,000 shares, and we sold them for $30 a share. So that would be a cash receipt. It would show as a positive for $600,000. Now we know, because we just learned in the last chapter, that of that $600,000, $5 would go in the common stock account, and the other 25 would go in the additional paid-in capital account. All we're interested in for this exercise is the total dollar that we received. Selling our own stock is considered a financing activity. Letter C says we sold equipment with a book value of $68,900. We sold it for $72,400. When we sold it, what happened? Someone paid us, right? We have a cash receipt. How much did they pay us? $72,400. We said selling real property like this equipment is an investing activity. Just like buying new equipment would also be an investing activity. We'll come back to this later, probably next class by the time we get there. But when we sell the equipment for more than its book value, we also have a gain. That's review from chapter 9. So when we sell the equipment for more than our books say it's worth, we record a gain. That gain shows up on the income statement. And so again, just like we have to deal with the loss on retiring the bonds, we have to deal with the gain on selling the equipment in the operating section. We'll come back to that when we get to discussing the investing section. Letter D says we purchased some land. This one's pretty straightforward. We purchased land, we paid cash for it. We're going to show a cash payment of $825,000. Buying land is an investing activity. It's real property. How about letter E? Purchased a building by paying $30,000 in cash and taking out a mortgage for $570,000. Well, we obviously have a cash payment there for $30,000. Buying the land is considered an investment. Or sorry, buying the building. Excuse me, we're on a building. Buying the building is considered an investing activity. Well, what about that other $570,000? That's a financing activity. Borrowing money is a financing activity, but did it affect our cash? No, it will in the future affect our cash. For this year, for this period, the only cash impact is the $30,000 down payment we made. GAAP says though, yeah, but you can't just issue a $600,000 liability and not recognize that, not point it out, not declare it. And so that mortgage payable in exchange for a building or most of a building kind of belongs on the cash flow statement as well, even though it's not cash. And here's why. Because buying the building is an investing activity. Borrowing money is a financing activity. Both of those things, both of those types of activities are included on the cash flow statement. And it will affect our cash later because we have to pay back that mortgage. So GAAP says you have to tell people you did that, but they're really not specific. I say they like it's a group of people. GAAP is not specific about where to disclose it. In practice, many companies will just add it in a separate schedule at the bottom of their cash flow statement. We're not going to get that specific about it. I just wanted to point out we can't just pretend that didn't happen. We can't just hope nobody notices. You have to tell people you did that. It has to be disclosed somewhere. And so many companies will choose to put it at the bottom of their cash flow statement as a separate schedule because it's related, because it involves investing and financing, even though the $570,000 wasn't in cash. How about letter F? We sold a new issue of bonds. When we sell the bonds, do we receive cash or do we pay out cash? We receive cash. Yeah, that's the whole reason that we issued the bonds in the first place, probably to generate some cash. I pointed out we may have done that in part because of retiring those bonds up above. It may be that we sold them, sold these new bonds at a lower interest rate. We sold them at 98. So we learned in chapter 11 what that 98 is really an index. It means 98% of the face value. So it's a cash receipt for 98% of the $400,000. And that would be $392,000. 98% of the $400,000. And that is a financing activity. Any questions so far? Letter G, we purchased 10,000 shares of $10 par value common stock as treasury stock, and we paid $22.50 per share for it. We're repurchasing our own stock. So it's on the open market. It's being, it's out there in the hands of investors. We buy it back for some reason. We talked about in chapter 12 a number of reasons companies might want to repurchase their own stock. So 10,000 shares, we paid $22.50 for them because we were paying for them. It's a cash payment. And the total cash that we spent, $225,000. $22.50 per share times 10,000 shares. And that is a financing activity. Finally, we paid dividends, paid cash dividends. I already told you that any transactions related to our own stock, whether it's selling new stock, buying back treasury stock, paying cash dividends, all of that is considered financing. So they don't tell us how many shares we have outstanding. We know from chapter 12, we only pay dividends to the outstanding shares. We're not going to pay dividends on the treasury stock because we own the treasury stock. We're not going to pay ourselves dividends. I don't even know what that would look like, how that would happen. So with what we're given there, we have 1 million shares issued, but 180,000 of those are no longer outstanding because we bought them back. So we have 820,000 shares outstanding, and that's how many shares are going to receive the dividend. 820,000 shares at $1.25 each. The total cost of the dividend, $1,025,000. And of course, that would be a cash payment. Check marks in there. So any questions before we keep going? And these first three exercises, the first two exercises are really just kind of giving us the sense of how things affect the cash flow statement before we actually get to working on one. Okay, so if there aren't any questions, let's move ahead to our next exercise. And so this exercise is simpler because we just have to answer that extra question that I had on for exercise 1. For each one of these items, does it appear in the operating, the investing, or the financing section? So what I would have liked, if I had created this exercise, there would have been a fourth option, which is it's not on the cash flow statement at all, and I would have thrown in a couple things that don't affect the cash flow statement. But really what they're telling us then is every single one of these transactions is going to appear somewhere on the cash flow statement, and our exercise is just to determine which one of the three sections. So we'll start with net income. We are told to assume that the company is using the indirect method. As I told you, that's the only one that we are doing for class. So if we're using the indirect method, net income is the very first item. We already saw that on that kind of template in the PowerPoint. Net income would show up in the operating section of the cash flow statement. Paying cash dividends to our stockholders, which would that be? Financing, yep. Anything related to our own stock is a financing activity. So that would also include selling our own stock, selling new shares of stock. Anything related to the principal that we borrow and pay back is also considered a financing activity. So that would include issuing bonds and redeeming bonds, paying off bonds. As I already said, what would not be included here, and I'll put a note here to remind us, what would not be included in the financing section is paying the interest. So the interest is an operating activity. And if you think about it, that makes sense because we show the interest expense on our income statement. It is already included in this net income. Sold long-term investments. As I said, this could be, those long-term investments could be stock or bonds in another company. It could be government bonds. Selling long-term investments is part of investing, right there in the word. Buying back our own stock as treasury stock is a financing activity. We already covered that. Selling equipment or buying new equipment is investing. Selling preferred stock, issuing preferred stock is a financing activity. Buying buildings and patents or selling them investing. So hopefully at this point, you have a sense of the three different sections in operating, investing, and financing, and the types of transactions, or the types of events in our company's operations that affect each one of those three areas. Because we are now ready to actually start looking at the cash flow statement in exercise 3. Any questions before we move on? Okay, let's move on then to our next exercise. Let me get that writing off the screen. Okay. So our next exercise gives us the opportunity, feels like finally, gives us the opportunity to look at the first part of the cash flow statement. So I want to just take a look at what we have here in letter A. Of course, if this was an actual financial statement, we'd have those 3 lines. We would need the name of the company at the top, so right here. Then it would say statement of cash flows. This says partial because we're starting out only looking at the operating section for the first 2, this exercise and the next one. We're just looking at the operating section of the cash flow statement. And that's why it says, actually, maybe just 1. For now, we're just looking at exercise 3 for the operating section. And then we'll have another example in exercise 9. And then exercise 10 also. Yep. So exercise 9 and 10 are all our additional examples. I think we'll do exercise 3 and then we'll jump ahead to exercise 9 so that we can work on that again. We'll save exercise 10, which is the full cash flow statement. We'll save that for the very last thing that we do in our next class as we finish up the chapter. We'll pull everything together and look at a complete cash flow statement. But again, this says partial because we're only looking at the first section. You know, it's the longest section. I already mentioned that. You'll see more information here than you'll see in any other section. If you were to look at a real cash flow statement, and I don't have an example right in the PowerPoint, but if I were to pull up a moment here. I'm just pulling up Twitter because everybody knows, I assume, everybody knows what's going on with Twitter. So we're just going to pull up their cash flow statement. Don't want that. All this stuff out of the way. So if we look at their cash flow statement, and I just randomly chose Twitter because they're in the news, and it's just going to keep popping that up every time they have a change in their price. Get rid of that. So this is their cash flow statement. Here's their operating activities. You can see how far that goes. There's investing activities and financing activities. They've got a lot going on, actually. And then it's blocked. There it is. So then you can see their change in cash here at the bottom. So Twitter may not have been the ideal example because they have a ton of stuff on there. Let me just choose a different company. So if we look at Google, you can see that there's a lot of stuff here in their operating section and not so much in their financing section. Maybe even less in their, I meant to say not so much in their investing section, maybe even less in their financing section. And then we show their change in their cash and compare that to where they were. So you can see their ending cash position in whatever year this is, 2021 probably. Oh, that's the trailing 12 months. Look at the 2021. So you can see that their ending cash position for 2021 was 20,945,000. These are probably in thousands. Yep. So Google at the end of 2021 had almost $21 billion in cash. However, during the year, change in cash, during the year, their cash went down by just over $5 billion. At the beginning of the year, they had over $26 billion in cash. So there's some pretty big numbers. But that allows you to see what a real actual company's cash flow statement looks like. And again, when you work on the project for chapter 13, you'll be looking at your company, the company you chose. So back to our partial statement of cash flows here. You can see that in the operating section, we start with net income, or if the company had a net loss. And then we're going to have some adjustments. As I already showed you in Blackboard, the adjustments are divided into two areas, those that come from the income statement and those that come from the balance sheet. So if we go back over here and look at the income statement, we're looking for two different types of adjustments that we might need. Not all companies are going to have both of these. Most companies are going to have at least one. So the first type of adjustment we're looking at on the income statement, make that a little bigger. The first type of adjustment we'd be looking at would be non-cash expenses. And I give you the three examples. We've covered all three of these. As a matter of fact, we covered all three of those in the same chapter, in chapter 9. So depreciation, depletion, or amortization. Your company may have one, two, or all three of those. Most companies have at least depreciation. Many companies don't have the other two. You might see them even lumped together. So you might see depreciation and amortization together in one line. But we're going to go to the income statement to see, do they have any of those? The other adjustment coming from the income statement is the one that I already mentioned, gains and losses related to investing activities. So we saw two examples of that already, selling the bonds at a loss, and what was the other one? Oh, we sold some equipment. We sold some property or equipment at a gain. And so those gains and losses show up on the income statement. They're included in that net income, but they're not related to operating activities. They're related to investing activities, buying and selling equipment or bonds or financing. So if we have those gains and losses, we would need to address those as well. So let's see what we're given here. Net income was $93,700. If it was a loss, we would need to show it as a negative. Again, negatives and positives are absolutely critical on the cash flow statement, and it tells us we have to use a minus sign to show any of those cash outflows, cash payments, anything that decreases our cash or a negative adjustment. Continue reading. Next sentence. Depreciation recorded on store equipment for the year amounted to $31,200. Okay. What do we know about depreciation? from chapter 9. Depreciation is the accounting technique that we take that upfront cost of, in this case, the store equipment. We already paid for it upfront. The cash flow happened when we paid for it. But now while we're using that store equipment, we're reporting the actual expense, depreciation. That expense reduced our income, right? Expenses make our income smaller, but it didn't affect our cash. Everyone agree with that? Depreciation doesn't affect our cash. So what does it tell us to do here in the guidance that I provided for you? They've been subtracted on the income statement, but they did not affect our cash, so we need to add them back. Depreciation needs to be added back. We show it as a positive. It was subtracted on the income statement, and that's correct on the income statement. But remember, what we're trying to do here is reconcile that net income with our actual cash flows. And since depreciation did not affect our cash flows, we need to add it back. The same thing would be true if we had amortization or depletion. Again, we could have one, two, or all three. The vast majority of companies do have depreciation. Far fewer companies have amortization and depletion. They can be lumped together in one line. You may see that sometimes. You can list them separately if you choose to. The next set of adjustments then are from the balance sheet. And on the balance sheet, we're going to look at our operating accounts, which are the current assets and current liabilities. And you can see here I have 4 steps. For our current assets and current liabilities, there are 4 possibilities. We could have an increase in a current asset, a decrease in a current asset, an increase in a current liability, or a decrease in a current liability. So we're going to look at each one of the accounts, and they've given here only the ones that we need. Well, they've given all the ones we need. They haven't given us everything from the balance sheet. When we get to our final exercise on Monday, you'll notice that what they give us is the actual balance sheet. And then they give us some additional information. So what we do in exercise 10, at the end of class on Monday, is going to be much more realistic. You know, if you were going to prepare a cash flow statement, you would not have just the accounts you need. You'd have every single account. You'd have the entire balance sheet and have to figure out, okay, what do we do with this? Okay, so whoops, let me go back to our exercise here. So what they have given us is all of the current assets and current liabilities. You'll notice the very first one, as you would expect, the first current asset is cash. Well, we don't look at the cash balances until we get to the end. And we just saw that on the Google cash flow statement. The cash from the beginning and the end of the year belong at the end of the cash flow statement. So we're going to ignore that for now. We don't need that for the operating section. So we're going to be looking at accounts receivable, inventories, prepaid expenses. Those are all current assets. And then the next two, accounts payable and wages payable, are current liabilities. So as we look at each one of these, we're going to talk about why did it change, what happened, what would make that change, and then I'll show you in Blackboard the rule that we follow. What I would prefer is that eventually you don't have to look at those rules, those general rules that I've provided, that you just can think about, oh, what happened there? Why would it change like that? But until you get to that point, please make sure you're looking at those rules. That'll help save a lot of heartache, headache. But I'm going to talk through each one of these as well. So let's look at our, let's look at our accounts receivable. Now, as is normally the case, The newer information is to the left. So you'll notice the 65,000 is the ending balance and the $56,000 is the beginning balance in our accounts receivable. So what happened to our accounts receivable during the year? Did it go up or down? Did it? Did it? No, because the 56 is the beginning of the year. Because they're in reverse chronological order. So it went from 56 at the beginning up to 65. So it actually increased. Does that make sense? So let's see if I can find an option that says an increase in accounts receivable. Okay. Our current asset, accounts receivable, went up. Why would accounts receivable go up? What makes that happen? What does that tell us happened during the year? What's accounts receivable for? Customers buy some stuff from us, they haven't paid for it yet, right? So the fact that our accounts receivable went up this year tells us that we recorded revenues that our customers haven't paid us for, right? We recorded, in this case, the difference, the increase in accounts receivable was $9,000. We recorded $9,000 in revenues that we don't yet have the cash. Those $9,000 in revenues are included in this net income, but we don't have the cash yet. And so if we just look at the net income, it would lead us to believe that we have $9,000 more in cash that we don't actually have. No reason to think we won't get it eventually. You know, if a company is growing, you would expect to see their accounts receivable go up from year to year. So the net income overstates the cash that we receive from our customers because we reported the revenues, but they didn't pay us yet. If we go over here to these general rules and look at the first, oops, there we go, the first general rule, it's letter 4A. An increase in a current asset means that our cash is lower than we would think it would be compared to net income. And so in parentheses at the end, I tell you what to do with it. Show it as a negative in the adjustments column, and that's what I just did. I put in the adjustments column, negative $9,000. The revenues were included in our net income, but we haven't yet received the cash from our customers. So sometimes the minus sign, the negative sign, doesn't mean that we paid somebody. That's what this is right here, the negative adjustments. So we didn't actually pay somebody, but it's just that our customers haven't paid us yet. We included it in the income, but we don't have the cash yet. Does that make sense? As I said, if you don't follow the whole logic of, well, it's in the income, but it's not in our cash, and so we have to show it as a negative, I hope eventually you will see that. But in the meantime, all you have to do is refer to these rules, and it tells you exactly what to do with it. So all you have to be able to see is that, yes, there was an increase in a current asset. We need to show that as a negative, and you'll be able to do the cash flow statement with no problems. Let's go on to our next line here, which is inventories. So what happened to our inventories during the year? It decreased, it went down. Decrease in inventories. Well, what does that mean? Why would our inventory go down? Because we sold some stuff and we didn't replace it. When we sold it, we recorded the cost of goods sold, and that made our income go down. But we didn't replace the inventory. We didn't buy more. We didn't buy as much more as we sold. And so we showed the cost on our income statement, but we didn't actually have to pay our suppliers for it. And so that actually means our cash, in this case, is a little bit higher than what our income shows. The decrease in inventories was $2,800. We went from 50,000 down to 47,200. That's a decrease of 2,800. If we go over here to our second rule, a decrease in a current asset means that our income is lower. Sorry. A decrease in a current asset means that our expenses were higher than what we actually paid out in cash. So we show it as a positive, just like we did here. Again, I hope that it makes sense why we show it as a positive, but even if it doesn't, that's fine. You just have to refer to the rules. Let's go on to our prepaid expenses. So prepaid expenses, we know, might include things like prepaid rent, prepaid insurance. And so we deferred the expense on those when we bought the insurance policy or when we paid our rent in advance. We put it on the balance sheet as an asset. And then as we actually use the place that we're renting, or as our insurance policy lapses, then we record the expense. What happened to our prepaid expenses during this year? They went down, right? What that means is the insurance policy lapsed and we didn't buy another one to replace it, or our rent, we've used the rental place and we haven't yet paid a new rental agreement in advance. So a decrease in prepaid expenses means that we held on to our cash. We haven't replaced that. We recorded the expense this period, but we didn't actually pay for it this period. And so a decrease in our prepaid expenses means that our cash is higher than net income would indicate. It's letter 4B, decrease in a current asset, show it as a positive. Okay. Any questions before we keep going? Let's move on then. Now we're on liabilities. Accounts payable. What happened to our accounts payable during the year? It increased, right? It went from 17,200 up to 23,400. It's an increase of $6,200. Well, what would make accounts payable go up? It's kind of the opposite of accounts receivable. We owed someone else. We now owe our suppliers more than we did at the beginning of the year. So we've reported that we bought that stuff. We've shown the expense on the income statement, but we haven't paid the bill yet. We held on to our cash and we didn't pay the bill. So we've shown the expense, but we still have the cash. If we go on to our next rule here, letter 4C, the third rule, an increase in a current liability results in an increase in our cash compared to net income. We're going to show it as a positive. We didn't pay the bill. We held on to our cash. So our cash is higher than net income would seem to indicate. Again, our whole point here is reconciling that net income from the income statement to our cash because we use accrual accounting. Last one, wages payable. What happened to wages payable? It went from 6,400 down to 5,300, a decrease in wages payable. How do we make a liability go down? We paid for it, right? We used cash to pay for it. So a decrease in a liability means that we used cash. Our final rule here. A decrease in a current liability results in a decrease in our cash compared to net income. We have to show it as a negative. So we now have this whole column of numbers. We have our net income at the top. Again, that could be a net loss, and then it would be a negative. We have our adjustment from the income statement, and we have a bunch of adjustments from the balance sheet. To find the very last step for the operating section is to find our net cash flows from operating activities. And we do that by starting with the net income and just adding everything in that column. And when I say adding, obviously, if it's a negative number, we're going to subtract that or add the negative. So go ahead and add up that column. Pay close attention to which ones have negatives and positives. And I got a total of $128,550. Everyone get that same number? So what you'll notice is that the net cash flows from operating activities is more than net income. The $128,550 is more than the $93,700 in net income. And that's what we're going for. That's the goal, is to have our cash flows from operating activities be more than net income. If I were to go over here in Blackboard to the project for this chapter, go to number 13. So you'll notice in these questions is asking you about the net cash flows from operating activities. And so now you know where that number is coming from. It is important as you're evaluating the company's cash inflows and outflows here for number 2. That's chapter 14, sorry. For number 2, what you're really interested in is how did those two numbers compare? 128,550 is greater than the net income. That number, that ratio of those two numbers is very significant. If I were to just come over here, let me just scroll down here for a second. If I can get all the way, wow. Okay, if I can get all the way down here. It's not in here. So I apologize. So in chapter 14, and I'm not going to pull that up right now, but in chapter 14, when we talk about financial statement analysis, but I just don't want to jump ahead. The single most important number on the cash flow statement is this number right here, the net cash flows from operating activities. And in chapter 14, when we do some financial statement analysis, do some calculations related to these financial statements, that number is going to be very important for us. And we will be comparing that number to net income. And that's called cash flow yield. And it is a very important calculation for us. We're looking for that number to be greater than 1. We want the cash flows from operating activities to be more than net income, ideally. I've said more than once, the net income could be negative. You can see in this column of adjustments that we have some negatives and some positives. The total of all of those adjustments could also be negative. So if net income could be negative, if the adjustments could be negative, then the net cash flows from operating activities could also be negative. Clearly, that's not what you want. The analysis that we can do with cash flows, if that cash flows from operating activities is negative, the analysis is not very helpful. Some of the numbers are misleading. So some of them I would tell you, don't even calculate them if you're starting from a negative position, because the results you will get will be less than helpful and possibly even misleading. Let's answer these last questions. Cash flows from operating activities differs from net income because it does not use the accrual basis of accounting. And I've said that a couple times already. For example, revenues are recorded on the income statement when they're earned, regardless of when our customer pays us. So sometimes our customer might pay us in advance and we have those unearned revenues. Sometimes we might allow our customer to buy on credit and then we have those receivables, as we saw right here. So that is the operating section of the cash flow statement. Any questions at this point? So again, I would encourage you to keep track of that page of guidance that I just showed you many times in Blackboard. And what I would like to do with our remaining time is move ahead to exercise 9. And I would like you to try this. Let's do the first part together. And then I'm going to ask you to try the second piece, the balance sheet part, on your own. But there's something new in here. Selected data in thousands derived from the income statement and balance sheet of National Beverage Corp. For a recent year are as follows. So again, remember I said to do the cash flow statement, we have to understand all of the other financial statements first. For the operating section, our information is coming from the income statement and from the balance sheet, as you saw. Next class, we will be looking at how we might, in some case, how we might need to also get information from the statement of stockholders' equity. So we'll see that next class. But for the operating section, we're looking at both the income statement and the balance sheet. As always, because we're using the indirect method, we start with net income. So go ahead and do that. And I need to get back to my guidance page here. So what we're going to be looking at next, once we have that net income or net loss as our starting point, we're looking for those reconciling items. And as you know, the first ones are going to come from the income statement. So as we look at what's given from the income statement, we have 3 extra lines in addition to net income. So we already know what to do with the depreciation expense because we saw that in the last exercise. The last line that I have highlighted, other items involving non-cash expenses. So those are likely depletion or amortization or both. And so we know that those non-cash expenses reduced our income but did not affect our cash. So we know we're going to have to add those back. There's depreciation. And there's the other items. So go ahead and put those in. We already know what to do with those. We saw that in the last exercise. Reduced our income, but did not reduce our cash, so we need to add those back. I'm going to suggest there's really not a wrong order to put those 3 items. And when I first looked at this, I thought, oh, they're putting them from largest to smallest, but that's not even true. So I'm not sure why they decided to give them in one order up here and then have them in the cash flow statement in a different order when they didn't put them in largest to smallest order. Unless they're looking at this other items as kind of a miscellaneous, maybe there's multiple things in there. But the other piece of information is the gain. And in our first exercise, we saw that. I reminded you from chapter 9 that when we sell a piece of equipment or property, plant, and equipment, when we sell it for more than its carrying value, we record a gain on the income statement. Now we know the actual sale of this property, whatever cash we got for selling the property is included in the investing section as a cash inflow. But I told you in the first exercise, we're still going to have to deal with this gain because the gain is included in the income, but it's related to an investing activity. And we're doing operating activities. So that gain is included in this income, but it's not an operating activity. So we need to subtract it. Whoops, one negative there. What was the amount? 1188. We need to subtract that gain from the income. It's been included in there, but it's not an operating activity. So we need to subtract it back out. And right here in the guidance page in the chapter 13 reference materials, I spell out for you what you need to do. Since they're related to investing activities, you need to remove them from the income. So if it's a loss, you need to add it back because it's been subtracted. If it's a gain, you need to subtract it out because it's been included in there. And so that's why I showed it as a negative. It's a negative adjustment when you're trying to get it out of the income. What I would like to do, any questions about that? So I wanted to do that together because that's something new we hadn't seen in the first exercise. What I'm going to do now is pause the recording and ask you to complete the adjustments that come from the balance sheet on your own. I'm going to put mine on the screen as well. And when you have finished the rest of this exercise, you can restart the recording and check your work, or you can just use the check my work button. This will be the end of class. So if you finish the exercise and you're good and you don't need to check yourself, you don't need to watch the rest of the video either. Okay, so I have put in all of my answers for the current operating accounts, the current assets and liabilities. You can see an array of negatives and positives. To get the net cash flows from operating activities, then we simply add everything in that column, paying attention to which ones have negative signs. And I got net cash flows from operating activities of $58,020. So we can see that the company has both positive earnings and positive net cash flow from operating activities. The cash flow from operating activities is more than the net income. The cash flow yield then would be greater than 1, which is what we're looking for. Increase in accounts receivable probably means that we're selling more. Hopefully it does not mean that our customers are just struggling to pay us. Hopefully it means that we're selling more. This says it indicates, I just would put a caveat on there that it may indicate or probably indicates an increase in sales. In addition, we're paying off our accounts receivable, our accounts payable. So it looks like we're doing okay with liquidity, being able to pay our own bills. And so from this, I would conclude just on the basis of this, that the company is doing well financially. And so that is the end of our class for today. On Monday in our next class, we will pick up with exercise 4, looking at investing and then financing activities. And we'll wrap up class on Monday with a full cash flow statement in exercise 10. Hope to see you all then.